Hello everyone, I am Sharan Kulal. So we'll understand Rule 86B and some anti-profiting provisions of GSTs. So in 86B, we'll look into the applicability, conditions and exception in this rule. To whom it is applicable? Rule 86B says it is applicable to the registered person whose taxable supply is more than 50 lakhs in a month. If a registered person's supply exceeds 50 lakh in a month, then this rule will be applicable. So what are the restrictions under this rule? The maximum of 99% of the output tax liability can be paid through ITC. Rest 1% has to be paid through electronic cash ledger. Which means, with an example, if you have an output tax liability of 1 lakh, you can only set off 99%, which is 99,000. The 1% you have to pay in cash, which is 1,000 has to be paid in cash. So what are the exceptions? The first exception to this rule is if the registered person, that is proprietor, karta, MD, two partners, directors, committee members, trustee has paid more than 1 lakh income tax in last 2 financial years, then this exception applies. And the second exception is if there is a refund of unutilized ITC is more than 1 lakh, then this exception will be applicable. This is applicable mainly in inverted duty structure or where there is an export without GST. The next exception is if the individual has paid more than 1% of the cumulative output tax liability, then this exception applies. To understand it better, we'll look into an example in the next slide. So the fourth exception is if the entity is government department, public sector undertaking, local authorities, statutory body, then this exception applies. So we'll look into an example for the third point, which is electronic cash ledger. If they paid more than 1% of the cumulative output tax liability, then this exception will be applicable. So we'll look into an example. So assuming a scenario where in the financial year 24-25, till up to August, an individual has paid an output tax liability of 30 lakhs, of which 1 lakh has been paid by cash and the rest is paid by electronic credit ledger. So, since he has paid more than 1% of the output tax liability, this exception will be applicable. The output tax liability was 30 lakhs. He has paid through electronic credit ledger of 1 lakh and rest 29 lakhs through electronic credit ledger. The cash payment percentage comes up to 1 lakh divided by 30 lakhs. It is 3.33%, which is more than 1% of the cumulative output tax liability. Since it is more than 1% of the cumulative output tax liability, this exception applies. So now let's look into the anti-profiting provisions of GST. So why this provision was inserted in GST? Before GST there was VAT, and despite of reduction in VAT rates, it was not passed to the end customer. So this don't continue in GST. This provision were inserted in GST. So what are the objective of this provision? To ensure the benefit of tax rate reduction or input tax credit passed on to the end customer. So under section 171, it says that mandate to pass and benefit of reduction in tax rates or availability of ITC. We'll understand this better with an example. So section 171(2) says that power to constitute an authority to examine profiteering. We'll look into an hypothetical example for reduction in tax rate. For example, a chai shop sells a samosa of 8 rupees. Earlier the tax rate was 18% and later it was reduced to 12%. So in year 2018, where the GST rate was 18%, the cost was 8 rupees. On that he had to pay tax of 1.44 and was selling at 15 rupees, where he was making profit of 5.56. Whereas in 2019, when the GST rate reduced to 12%, the cost remaining same 8 rupees, the tax rate was reduced from 1.44 to 0.96, and still he was selling at 15 rupees, which increased his profit from 5.56 to 6.04. The difference in profit is not shared through his brand value or his reputation in the market, but through reduction in tax rate. This is profiteering and action can be taken under section 171 of CGST Act. So we'll look into an example for availability of ITC. So I have a hypothetical example for easy understanding. So there is a scenario before GST and after GST where the trader who used to purchase for 10 rupees had to pay tax of 2 rupees on which the credit was not available, and he will add 2 rupees as profit, and again he had to pay rupees 2 on tax while selling. So the total cost is to come at 16 and he has to sell at 16. So after GST, he used to purchase for rupees 10 and had to pay 2 rupees on tax on it. This 2 rupees he will get ITC. So on that you have to add 2 rupees profit, and while selling you have to pay tax of 2 rupees. Now the selling price won't come to 16 rupees because he will get 2 rupees as ITC available. So now the cost will be 14 rupees. If he sells at 16 rupees instead of 14 rupees, he will come under section 171 of CGST Act. If an interested person has to apply a complaint, so this is a procedure. If the complaint is of local level, the state level screening committee will handle the complaint, and if it is of national level, it will pass on to the standing committee which handles the national level complaints. If again it affects the national interest, then it will pass on the complaint to the Director General of Anti-Profiteering Provision, where they will inquire or investigate on this matter and send the complaint to a National Anti-Profiteering Authority with the findings within 6 months. So investigation by Director General of Anti-Profiteering Provision. So Director General of Anti-Profiteering Provision will submit a report to National Anti-Profiteering Authorities within 6 months with the findings, which can be extendable. The 6 months can be extendable. If it is proved that a profiting was conducted, National Anti-Profiteering Authority will pass an order within 6 months and reduce an amount of goods and service tax and repay the amount of profiteering with 18% per annum interest to the central and the state consumer welfare fund. Thank you for your attention.